Greetings, Dr. Jeffrey Scott, and this is my weekend market update for the weekend ending Sunday, February 26, 2023. I'm actually doing this midday on Saturday. I titled this week, Will Support Hold or Is a Bigger Retest Imminent? And I think that's a very legitimate question, and we'll talk about it. And enough of a question that it has me pretty conservative in how I'm going to approach the markets, at least as I think about them going into Monday. Again, my email is there, htsidoc@gmail.com. If you're new to my channel, I've done this pretty much weekly for, close to 20 years in various sites. I've got nothing to sell you, so if you're looking to buy stuff, not going to find that during this video. If you like this, please hit the subscribe button. And the real reason for that is I do these whenever I have time, so you never know what time to look. And if you hit the subscribe and the alarm, then you will get notifications when I post something. All right, let's go take a look at the markets. And again, thanks for being here. As always, this is for educational purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. That means I paid for the tools that I use. No one pays me to say good things about their programs. And I paid for everything that I demonstrate during this video today. Trading involves risk, and you are solely responsible for any investment decisions you make. This is a website that I do during the week, so I post something short, 5, 7, 8. Sometimes if I think there's major changes in the market, it might be longer. It gets posted typically around 9 o'clock in the morning Eastern time before the market opens. I don't have control on the posting of it. It's reviewed, disclaimers are added, it gets posted by a third party. So I can't control the time, but typically I usually get an email notification that it's up before the market opens. I don't do it every day. If I'm traveling, it's hard to do things every night or morning, but I try and do them whenever I can. I always like to start with the major markets, and you notice in yellow you'll see the major indexes. And first thing, look over here at the 5-day changes. The best performance in yellow is probably, well, there's none that are good. The Russell was down 2.6, the Dow NYSE were down 2.7, Spiders 2.9, and the technology laden NASDAQ closer to 4%. Now notice it's 5 days. It was a 4-day holiday, so this is including the prior Friday as well. I can't change that in the HDSI program that I use to generate this list. If we look at Friday performance, you can actually see the NYSE actually got back to positive, which I think is interesting. Why? Because you're looking at over 3,000 different instruments. They're all different types, small, big, a lot of energy in it, and that might explain why you look at the NASDAQ and the Spiders, which were down over 1%, 1.7 on the technology stocks. The Russell down 0.9. Dow down over 1%, yet the NYSE was positive. The other thing that pops out at me over here is you can see we're still way off those October 13th lows. When I talk about retest recent lows, that's still a pretty big drop. If we were to go retest those, I think my portfolio is mostly in cash, so I might not be too upset if that happened. But I think if you're heavily laden, gosh, if you're even margined up, God forbid, right now to the long side, that is a risk that I think is out there. Big performer on the week was natural gas, up 2.8, but interestingly, it didn't really happen until Friday. So when it was up 5.2. So for the whole week, last 5 days, it was minus 2.4 until Friday, where it brought it up to 5. Where the 5.2 gain. You could see commodities, oil were up. And the interesting thing is these things, which are probably tied somewhat to the price of the dollar, they were up despite strength in the dollar. Interesting. If we look at the sectors, they were all down over a 5-day period. I think if you looked at just the 4-day period, energy may have been up, but for the most part, everything was down. Now this is from the couild tool, and this is a Excel spreadsheet driven tool that my buddy Sagar puts out at superiorprofit.co. It requires metastock data, and that and I've talked with him so many times about could we get a different source. Um, he has a lot of customers in ex-US. In fact, he lives in Thailand himself, and they trade the Indian market. And apparently, one of the nice things about the Metastock data set source is that it does include international markets. He also told me that I don't, there's not enough of the underlying data to populate it using other sources. Well, I learned so much from this one page. Let me tell you what I'm seeing. First of all, 75% of the stocks in the S&P 1500 are below the midline in the Bollinger Bands. Now we'll show you the buckets later. This is um, you know, Sager has mimicked a lot of things I've done and built them into the program, which I love because it makes it better for me. But what he does even better is it's updated real time. I don't have a real time source that updates that for me. And this is the thing here that's interesting. We'll talk about the shift to the left, how there are very few stocks above the Bollinger Bands. Most of the stocks are below the midline, and we're starting to get stocks below. When we get to 30% below, we almost always start to see a reversal. So we're going to be watching that. How bad was it on Friday? 91% of the sectors were down. I think that means 1 out of 11 were up, and that was energy. 83% of industry groups were down, and 75% of stocks were down. If we look over 5 days, again, this goes back 5, which would be to the prior Friday because it was a Monday holiday, you could see 100% of the stocks were down, or the sectors were down over the last 5 days, 91% of the industry groups, and 81% of the stocks. So clearly another challenging week to make money to the long side. We've talked about climbing a wall worry. Kind of looks like Humpty Dumpty's getting ready to fall over. In my opinion, if Humpty Dumpty's the market, we'll see if he can find some strength and get propped up. But we've gone through hot employment, hot CPI, hot PPI, hot jobs, hot PCE. Um, at some point, the Fed is going to have to, you know, react, and I think the Fed's telling you what it's going to do. It hasn't said 50 basis points at the next meeting. It's still saying 25, although when you look at places that predict, it's increased to about 25% likelihood of a 50% raise. But they're talking more raises and longer. So that's not good for the stock market. If we look at rates on the 10-year and the 30-year went up mostly because of what I just said, concerns that the Fed is going to have to tighten more and longer. Now it's interesting when I look through 1,000 stocks plus every Friday night and Saturday morning. I did see some regional banks pop up, and I saw a lot of insurers pop up on my interesting list. And that's probably because those are two things that benefit from the rates rising. Now, rising rates are bad, but what about rising rates into the potential for a recession? So, to me, it's just a collection of thoughts here, and one of them is 10-2 or excuse me, 10-3 here inversion. And if you go back to the 80s, when we drop below this black line and invert, we get recessions. Now, the recessions often occur after you get back above the inversion line. So if that's the case, if every time it does this, you follow it eventually with that recession, well, we're still below the recessions yet to come. Here is a measurement of money tightness. Well, this is really tight, right? And this is probably what forced the Fed to do the massively aggressive cuts back in 2020. Well, we're off where we came. I'm not sure this is considered high, but it's higher than it was. And I'm watching that closely because a spike in tightness of money would be a precursor of economic problems. And then if you look at the PMI, and this is from the Philadelphia Fed, again, going back to the 70s, typically when we drop down, we get the gray bars, which is recession. And why do I worry about recessions? Because we can go much further than those October 13 lows in a bear market that occurs in a recession. Um, Now look at where we are today. Um, we are kind of getting below the point or the line in the sand. Let me just draw that. We're kind of getting below the line here. If you look at that line, and I'll give it that we're still there, but where that line was, right over here, for the most part, anytime we stopped there and didn't go further, we didn't get a recession. Well, we've dropped below that line a teeny bit. So I am concerned about risk of recession, and I clearly will be considering that in my trading plan and how I go forward. No guarantees we're going to get one, and I know there are plenty of people out there saying too much concern is being based on the risk or thought of a recession. Now, 2 weeks ago, we were talking about the market being oversold. You could see the peak in stocks above the 200-day, stocks above above the 40-day, and you could see my trusty 2121 13-week new highs. And this is out of TC 2000. It's the only place I get this indicator. Um, Although I'm sure I could construct it in other places. And what I said, and I continue to say, when I hit this line, the market pulls back. Well, we hit the line, the market pulled back. When I hit the line down here, the market bounces. So we're in the middle, but we're starting to drop pretty hard. And I'll be looking for that for a sign of at least a short-term bounce. And then, going back to Sager and his superior profit, .co, this is a market breadth tool. And I love this tool. And, there's a lot of stuff here and a lot of stuff I just showed you. Stocks above the 50 in yellow, stocks above the white, and then how many stocks, have the 50 above the 200, which I think is such an important measurement because when the market rolls over, that thing will tank. The green line here is that 13-week new high, new low applied here is a broad market, but it's also applied to the individual groups, whether I look at the S&P, the Dow, the NASDAQ 100, S&P 500, and you can see on all of them it's come down off of very overbought areas. But what I really get interested down here, because this sort of gives me a sense of how much distribution is going on across the different markets. And you can see those red dots or green dots would represent the NASDAQ, the NYSE, S&P 1500, S&P 500, the NASDAQ 100, and the Dow. Well, what I see here is a lot of distribution has come into the markets. That's a worrisome thing, and that is something that might make me think we're still going lower. Notice what happens at lows. We see a lot of accumulation coming in with the green dots. A lot of accumulation. We're seeing the red dots. Those red dots come in at the tops, not typically at the bottom. The buckets, again, this is buckets being run in EdgeRater. This is what I've used historically. There's a lot of data that I can generate underneath this. I can look at any specific data in the market. I guess technically it would update real time, but it's not going to sit up as a gauge on my computer, giving me real-time updates. And again, this is that left shift where more and more stocks are in a bearish pattern within their Bollinger Bands. And as you can see, over 10% of the S&P 1500 are currently below their bands. At 30%, it gets interesting. No Hindenburg omen? Of course not. Why would we expect a Hindenburg? We got to get closer to a new high. What's interesting is that over the last couple of weeks, I've been applauding, even on the NASDAQ, the lack of new lows and the fact that we're seeing new highs. Well, that reversed. We've got new lows without new highs. That, to me, is a bad omen for the market. And the fact that I've lost the new highs on the NYSE is bothersome, but notice there are no new lows. So we have a lot of danger signs. None of this says the market has to die. Now, this is one I'm scratching my head on. First thing is the vast majority of the market was below zero, meaning the vast majority, when I break up by EPS rank plus relative strength rank plus group rank, the vast majority of the market, as you could see here, was trading um, downside. I don't know how to explain this spike unless perhaps Nvidia and some of the other stocks with earnings live in the middle. For the most part, earnings per share rank did not help your performance, and relative strength rank favored a zero. So this is still junk off the bottom. Know your news and your earnings. Well, it's not a clean week with nothing. I mean, we've got some credit, employment, JOLTS, Beige Book, jobless claims, and employment report. And it hasn't populated yet, my source, how many Fed speakers are out. But we got to be getting close to the next meeting. So perhaps, oh, I don't know when there's a period of time before the meetings where they can't talk. Because the Fed heads, if you haven't noticed, they talk, the market drops. They talk, the market drops. Now, also, there's a lot of earnings this week. What I like to say is it's a judgment call to hold stocks over earnings. It's bad judgment to not know when your stock's earnings date is scheduled. You look at winners like Nvidia, and you know why you want to hold stocks over earnings. But plenty of stocks just will tank on earnings as well. So you have to really have a cushion in it. Um, you know, I actually closed out my Axisome. I closed it out about a week ago. I just didn't like how it was performing, and it's got earnings before the open on Monday, which I don't like earnings before the market opens on Monday because I got absolutely no chance to change anything that I'm doing. I don't like trading before the open, and a lightly held NASDAQ stock is not what I would ever trade pre-market if I could potentially avoid it. Market thoughts, another losing week in this holiday shortened week. Um, the things we talked about, jump in yields, rise in dollar, growing belief that the Fed's got to keep rates higher for longer. Treasuries going up, so the yield and the dollar are not our friends. Only one sector up on the week, as I mentioned, which was energy. The recent leaders, technology and discretionary, led to the downside. As I've kind of been alluding to, we're at an interesting junction for the bulls and the bears. Late Feb and early March are often seasonally weak, and I think that's supposed to be EAK, sorry about that, and volatile, yet some of the recent major market bullish reversals have occurred in March. Think of March 9th in 2009, March 23rd in 2020. So perhaps good news could be coming. That said, the question is whether or not support holds. I don't have a crystal ball. We're at near multiple support levels. We've eased off any overbought scenario. And with the lessened news flows, maybe we get our bounce here. No guarantees on a bounce, but this market wants to continue to run independent of what the Fed is saying. This is where I expect to see the Alamo. This is where we're either going to hold or we're going to fail. And I lived in San Antonio for a long time. The Alamo failed. And the other thing is, if you ever go to San Antonio to see the Alamo, it's a whole lot smaller than it was on TV. So, last other thing, my weekly timing system has gone negative on the diamonds, lost strength on the others. At times like this, where market risk is up and down, it's good to remember that cash is a position, and it will get easier to trade in the future, whether you're a long or short person. This is a week where it could go either way. For me, still time to raise cash. If I trade, I'll trade small size and use less risky option trades. For those who are new to me, I usually do this for 20 minutes and then I jump into a program and I show you how I do my approach in that program. We'll look at major markets, we'll look at yields, we'll look at some stocks. And what I like to use is Wealthcharts. And let's go and start and let's look at what happened on Friday. So Friday was typical of so many days of late. Bad news or concern about rates. PCE index was high. So what happened with the spiders? They gapped down at the open. traded pretty sideways until nearly 3 o'clock, ran up, pulled back, and then closed on an up candle well off the prior close and nominally higher than where it opened or where it opened on the gap down. So higher than it opened, so you'll get a green candle, um, but not a very strong day. Now the interesting thing, if we go on the daily candles, so there's your green candle, minus 1.07%. So just give you the AAA triptych map of what I see in the markets. Highs in the market going back to January 4th. Multiple bear market rallies failed. Bear market rally failed. Bear market rally failed. This bear market rally did not fail. Unlike all the prior ones, the MACD was actually in a bullish configuration on this attempt. The MACD is now rolled over. This line is that long-term bearish trend line. This here, and as you can see, move it up a little bit, is connecting the higher lows. This here was a bit of a wedge that I thought was forming, and we've broken down below that wedge. So that's the basic geography. Volume was not light on Friday. You can see the MACD has gone negative. So why do I think we're at critical juncture here? Well, we've broken through this trend line support. We're just above this long-term trend line where resistance turned into support, and something that was resistance for a year might turn out to be good support. We've got the 50 right about where we closed, the 200 right below. So think of all those areas here of potential support. If we break through this line here, I think the October lows, which gets you down to here, are things that are still in play. And folks, that's 500 plus, almost 600 S&P points away. So let's hope that we hold in here. Now, a hold and a break above what this line is going to continue at. All of a sudden, we're going to look like we might be in a little triangle pattern, and a break above that would obviously be bullish. I like trend lines and probably like them too much. If we look at the Qs, similar pattern. It broke down here. This line here, which is that long-term bullish line, is way far away. But what you're sitting is right on the 200, right above the 50. The diamonds, I put this on during the week because it almost feels like it's going sideways. It's the bottom of the box, a place you might expect it to bounce. The Russell has pulled down to this line here, right above the 50 and the 200. It's also in a place you'd expect it to bounce. One looks at the VXX here as a measure of the VIX. You could see a shooting star failing at the 50. That's a bearish candle, even though it was a positive trading day. That could be a resistance area. But the thing that has me worried here is the US dollar. This was my line in the sand. It's no longer a valid line. The question is, will the 200, because if this thing continues to go higher, that portends bad outcomes, in my opinion, for the US stock market. Commodities. Now, if dollar's strong, gold's weak, silver's weak, oil's got lots of things that drove it. Oil was actually up. Now, what's interesting is, as I showed you in the beginning, natural gas was up. And when I did my Friday video, I flubbed it a little bit, but the intent was good. And I said, based on an oil price of 67, that I thought the 849 was way too low. And that's about a 1 to 8. So I tried to ask the question then in my mind, how many multiples of natural gas should oil be? So I built a ratio chart. And this is a ratio chart, and I think there's clear seasonality um, to this chart where in September, oil sort of bottoms, and then oil starts to run up until February, March, and then it trades down. So you would expect to see oil range from maybe 3 times natural gas at its low, maybe 5 times natural gas at its high. And we could go back further and further, and you could see this pattern. All right, here's 6 times. We got up to 9 times. I think that natural gas is going to play catch up. I don't think right now oil is so far high that it's going to correct because it's too expensive. I think it's still cheap, perhaps, compared to where it's going. So I think natural gas does become interesting here. Um, it's bottom fishing at best. It's way off. And I also talked about last week looking at something like Boyle if you really like heroin because that's in speed because it's a 3x natural gas trade. And now the other thing that's interesting, despite the fact it's going sideways when the spider's dropping. Let's take this out of 15 minutes. Let's put it into a daily chart. Um, but how is natural gas faring against the spiders? And you could see it's actually, perhaps maybe it's bottom. That's probably overthinking it. 10 years, this is another thing that worries me. This was the recent double top. It broke through it, still going sideways, consolidating above that. This is not a Darvas box. It was mostly to call my attention to it to see if it comes out of that box. The jury's still out on the 10-year, but if the 10-year keeps going up, the dollar keeps going up, it's hard for me to be bullish on the stock market. My weekly market timing, two things have to happen. I have to close above the white line, which is a 30-week WMA. I've got to have a green bongo. We failed on both, so the diamonds are not even, technically the diamonds are in a sell signal. It's an early signal, so I don't put a lot of weight into it. Um, but the spiders, the IWM, and the Qs have big red weekly bars are all approaching that 30 WMA. So technically, I've got I'm still bullish on those three, bearish on the diamonds. The reality is I have no conviction either way. Yes, I'm still bullish, but I'm not looking to put new money without a change in the direction. And yes, this is bearish, but I'm not bearish enough to go short because I think the market is at a period of time where a bounce is not impossible. Looking at market theme, I'm just looking at the short term. When we're up here, it favors big cap. Down here, it favors small cap. We had a run favoring big cap in the market rally during February, but during the sell-off in later February, you could see that it's favoring small caps. And if you think about the quote junk off the bottom, it's been those ARKK like small caps. This is, if we look at it on the long term, you could see that large caps have come off their peak, but on a longer term, large caps have been performing, and on a longer term, so has, down here is where you see value. So longer term, large cap value, which is defensive, but on shorter term, we're seeing interest in small caps, and we're also seeing interest in growth. So small cap growth, again, things like ARKK, IBD 50, but they stopped working this week or working as much. Now, one way of understanding what's working in the market, or really short term what's changed, are these ratio charts, which are hourly ratio charts, so they're short term charts. I'm comparing each of the 11 S&P sectors versus the spider, and by doing that I sort of neutralize what their actual score is, and I look how they're relative to each other. Now, short-term super strength is when you see something go straight up like this with a blue line. So materials seem to be waking up. Financials seem to be waking up. So those are two that if I wanted to put money bags on as things that look to me like they're changing and might be something to pay attention to, I'm going to look short term maybe at materials, Probably more likely to look at financials based upon my review. And financials to me include things like insurers, which have really started popping up as some of the more intriguing chart patterns, or safer chart patterns that I saw. And if you were here in the beginning, I commented that insurers like rising rates. Now, longer term, I look at what's up here in the upper right hand corner, and there's no question that discretionary and down here in technology down here have softened, but are still over a longer term have outperformed. Staples has increased of late as risk has come in, as have utilities, and healthcare is struggling. Energy, a little bit of a green shoot here, and I will tell you that despite a tough week, this was the one sector that was up, and there was a lot of bottoming, not not great breakouts, and not stocks and great bull runs, not true market leader patterns, but there were some interesting patterns in energy that we may take a look at. So my basic premise is this is a market that is mixed. Um, we could bounce, so I'm going to look at some bullish plays, but I'm not convicted to where I want to put a lot of my money at work. I didn't talk about much when I said one of my lines on my market thoughts says if I trade, I'll trade small size and use less risky option trades. What is a less risky option trade? Well, a vertical where I'm buy or sell close to the money and then sell if I bought or buy if I sold out of the money is a defined risk trade. And the fact that there's a second option, the opposite direction, will reduce the cost of my trade and the risk of my trade. A butterfly can be a symmetrical trade where if you get a big move, you may lose on the trade even if you're correct directionally, but it's a very inexpensive trade. You just got to be really good at picking your targets. I like to do unbalanced butterflies, which cost me a little bit more money, but I can win even if the stock exceeds my expectations. Um, Naked trades right now are obviously more expensive, whether it's a call or a put. Um, and right now, with my conviction being low, I'm less likely to do those. But let's take a look at the bull scanners and see if we can see anything that's interesting. So first thing I want to look at is the heat map. Does this look like a bullish map to you? Certainly does not to me. This is the S&P 500, so you're not going to see a lot of small banks in it. But what you will see are JP Morgan, Goldman Sachs, and Wells Fargo all holding up well on a horrible day. This is a big drop. This is Adobe, and that's because the SEC is seeking to block a transaction they want to make, or an acquisition that was going to create some accretive numbers early on. So market was not happy with that. Out of curiosity, let's look at the Dow, JP Morgan, Goldman Sachs, and it's got energy here. Okay. Let's look at the NASDAQ 100, which is very technology, very red. And then let's look at the Russell 2000. That looks different than everything else, doesn't it? It just shows you that, well, first of all, when I think of Southwestern Energy, I think of natural gas. This is another energy play, energy play, energy play. So there was clear benefits in energy. Now let's go look over at Wealth Scanner and see if any of the industry groups, indexes, has anything that shows me I need to really think strong here. So I'm looking at different things. I'm looking at the arrows. I'm looking at the total score. I'm looking at the flames. Flames say you had a big move. Well, having a big move in a volatility instrument isn't really a good story if you're bullish. The dollar being up near the top is not a great story if you're bullish. And TBF goes to the top when the markets are weak. So there's nothing here to get excited about. I'll also point out in a strong market, you're going to see a bunch of 800s, and there's nothing close. So there's no big conviction in industry group or sector. No surprise. Remember those Q charts I showed you in the beginning where the vast majority of the market was down last week? Well, and I'm just going to remind you of that. Whoops. Over the last 5 days, all sectors were down, all but energy were down, and 80% of the stocks were down. So we wouldn't expect to see a lot of bullish looking sectors here. Now, the benefit of the CAT scanner is a tool that I sell a couple times a year during the Wealth 365 event, is that I've taken my style of trading. What is my style of trading? Find stocks in a longer term uptrend. That would be my weekly bongo. That pull back on the daily and then start to break out and go higher on the daily. And that would be my daily bongo with a reversal within just a few bars. A squeeze is good, and then I have 4 different impulse indicators. It could be bullish or bearish. And if I can find a stock that meets my trending criteria with a pullback and then shows a lot of conviction with my impulse indicators, then that's the kind of stock I want to look at and see if it's a potential buy. Now, when I've gone back and looked at true market leaders and great performers, I would see the same pattern over and over again, and that's the pattern that I'm going to look at right now. So let's just look at the weekend review, which are a couple of bullish lists I put together from a top-down and bottoms-up perspective, and let's see if anything comes to the top. Now, remember, we're in the heat of earnings season, so a lot of the things are going to look strong because of earnings season. So one of my favorite plays right now is CNO Financial. CNO Financial makes sense. It's an insurer. I talked about insurance companies go up during the setting of rising rates because of their portfolio of investments. And if you look at CNO, does it meet my criteria that I described I wanted? So the first thing I want is to see a stock that's in a long-term uptrend. Well, if we go back here to July, when the stock was 16 and now it's 25, you've had a 50% move over the last 6 months. I can accept that's in an uptrend. In fact, if you look at the weekly bongo where my pointer is here, that's a long-term or weekly trending indicator. The fact that it's green and steady green says I'm in an uptrend. Here is the daily chart. Remember, I want to see a pullback in a long-term uptrend and then a move up. And notice that the daily bongo, here's a daily, weekly, and monthly, pulled back and now just reversed. We're in a squeeze, and we've got 2 of my 4 dots. We have the momentum and the breakout dot. So I look at this as a very interesting stock. I look down here at the high jump. It's at 72%, so it's not overly extended. And then other things I like to see is I like to see the relative strength turn up. And look at what happened when the relative strength turned up on the weekly. Well, I like to buy it when the relative strength turns up again. And this is on balance volume versus its 10-day period exponential moving average. So this is a setup that I like, and if I was to play in the market, this might be one I look at. But I've ranked, and there's a lot of other stocks here, so why don't we look at 10 of these or so. Beacon Roofing. So, it's funny, housing should suck right now, right? I know that the existing home sales in lots of the country are tough because of credit and the higher rates. Down here, people still pay cash in South Florida, and house values keep going up. But this is a company that might benefit from any strength in the housing industry. And if you watch Toll Brothers and Pulte, and over the last couple of weeks, their earnings have been strong. The new home permits are turning up. Here's your 4 dots. The top dot is a gap. Now, you may get a 4 here and only 3 here if you close in the bottom part of the bar. So here's a stock that gapped up, actually gave up some of the gain, and then closed close to the high on massive volume, which is the second dot. The third dot is a breakout of recent resistance, and the fourth dot is showing momentum. Look at relative strength in OBV, and there's your short-term reversal on the daily bongo with a weekly bongo green. Now, to be honest, I do have concerns about the housing market, so I'm not sure this is one that I would play, but you got to just go through what the signals are telling you. BWX Technologies, this is one where I lost the fourth dot. Why? Because I did not close near the high of the day. I came off the high. Still, to me, in a sideways move, probably would watch it. Now, beyond beef, this was an earnings play and clearly not a pretty candle. It may go higher. You can see that it's been in a horrible downtrend for quite some time. Been uptrending it since October. You can see the weekly bongo went green. Now, big gap up, but it traded this high and closed near the gap. Can you trade this? Absolutely. And there are trading rules taught by Gil Morales how to trade gaps like this, which look at putting your stop probably a little bit below the low of the day. And the more volume, the merrier. Look at the relative strength in OBV. I just don't like where it finished. Katos, this is a defense play. This one lost the fourth dot because it came off the top, but this one closed above the 200. Also has another one of my indicators, the EMS signal. Look at relative strength in OBV. This is one that made it to my buy watch list. Resolute Forest Products, don't know much about this guy. Again, a reversal after a gap up I don't like to see, but this looks like a news event drove it, and now it's just trending up at a 45-degree angle. It's an interesting looking pattern. I'd have to do a little bit of research and make sure this isn't a takeover candidate, because that's what this bar looks like. Zeta Global Holdings, this is one that was an earnings move, and you look at it, it's been in a weekly uptrend going back until July. Relative strength has been steady above its moving average. This is relative strength versus the spider. Weekly bond goes green. You had a short-term reversal, 4 dots. This is one I like a lot from a pattern as well. You might notice that it's extended, but when I look at it, do I see an extended stock? I don't, but it is getting far from the 200-day moving average. So that would be the only concern, but when I would not hold that against that pattern. This is a international bank, and this one had a big run. Now, is this a cup, a handle, and a breakout with big volume, 3 dots, strong relative strength in OBV? This is one that I liked. If you're looking for another defensive play, here's one that pays a dividend. It's a utility, Edison International, coming out of a squeeze, so a sideways move. It had a volume breakout and momentum. Look at the relative strength. So, notice what's happening here is I defined the overall pattern, uptrend longer term, short-term pullback, and then impulse indicators plus or minus a squeeze. And every one of these stocks in a horrible market starting at the top actually looks interesting. FTAI is in the, I don't know if it's aircraft leasing, maintenance, it might be maintenance. I think this is the old Fortress, I just can't remember. Big breakout here. And notice what happened. You had 2 dots, and then you had 1 dot. You had the EMS come in. You came out of a squeeze. You had relative strength in OBV. You ran up. Here's your short-term pullback. And now you got 3 dots and you're running again. And then I just want to show you FTI, which is in the oil services space. Nice little run up here. And You've had 2 days in a row with multiple dots, reversal in the daily bongo, great relative strength in OBV. When I see multiple momentum dots in a row, I get excited. So FTI is on my watch list for this week. Let's look at LIN. This had an interesting move. It must have been in earnings, but I think it's specialty chemicals. I don't remember for sure. But this to me is a belt hold day where it actually opened up low. In fact, engulfing the prior 2 days, 3 days. And then it just closed on its highs. In fact, if you look at a daily chart on something like this, imagine if you sold it here because you got nervous at the gap down, and then you get to your 11:30 period of time and the stock just ran up crazy. Um, there's a $20, $25 difference between if you sold it at the open. Big day, maybe that day is going to be too hard to find a reasonable stop. I'd probably be looking at the stop here a little bit under the 50, maybe under the 17. So I could probably get that at 5%. But look at the massive volume. Again, same pattern as all these stocks. Weekly uptrend, pull back on the daily, and now a breakout and going higher. I could go through all of these. And so many of these stocks looked interesting. I already showed you CNO. And we'll just finish on the bull side with Range Resources. And this is an energy stock. Wasn't my favorite. In fact, probably my favorite is one that somebody brought up about having new management when I did my weekly intensives a couple weeks ago. And it's now starting to move. I am interested in EQT here. Don't remember what that line is. It's probably something. I just don't remember. But look at EQT. So it had volume here and momentum. It broke out the prior day, coming out of a squeeze with relative strength in OBV. EQT looks good to me. And I think EQT, RRC, SWN, all these stocks are beaten down. CHK, Chesapeake. I think these are all plays on a natural gas reversal. So I'm now at 47 minutes. Let's think about what we've done in 47 minutes. I spent about 20 minutes pontificating what I think about the market. And then in the next 27 minutes, I was able to look at the market from a top-down approach and then go through, identify some leaders in this market, and I could stop right here. I want to do two things. I want to run the same scan for the bears. So I'm looking at long-term bearish, short-term reversal to the bearish side. So here I'm going to look for stocks that have been falling, that have just reversed to the upside and turned down again. Same thing with the dots. You won't see 4 dots here because there's no big gap up. So let's take a look at what we see and see if anything looks interesting. Now, when I see a move like this, a big gap down like this on Autodesk, look at relative strength and OBV. This is tempting. It's already fallen a lot, and after a move like that, I might expect to see a bit of a stuttering pattern. But if I saw something that looked like this, and it got back up to that 200, and then it turned down, I would be very willing to look at going to the downside. But I think after the first move down, I'm not sure I'm ready to short that. Monster. A failure at the 50. I think I would watch this one as well come Monday if the general market drops down. And this thing can't get above the 50, especially if it goes up to it and fails. That would be what we call an ice hole failure. And I think there's a risk of it coming down to the 200. ADC hasn't broken down below the 200 yet. AMH, well, that's a clear breakdown. Let's look at this a little bit deeper. Stocks in a downtrend, rally, but it's back in a longer term downtrend, and it's failing here on the shorter time frame. And again, look what we got here. Relative strength heading down, OBV. There's a lot of stocks that are going to pop up because of the market we're in. So we talk about, this has got something that I wanted to talk about. Again, I'm not saying that this is a perfect market to short, but what I want to show you is the patterns that I use to go long also work to the short side. Remember when I said a failure of the moving average and a breakdown? This was one that would have been a beautiful thing to short on Friday, probably still shortable, relative strength at OBV. Why? We're in a long-term downtrend, no surprise. We pulled back into the moving averages and we failed. That's what I like to short. Now, something popped up on the left. I want to just talk about this guy and talk about how I think this is like Moderna at $500, which turned out to be a great short. Here is a stock that has no revenue, no earnings, and ran from 56 to 310, 320 on news about a positive early study, early being the key word, in a disease called NASH. And I looked at that pattern and I wanted to short that so much, especially on the shooting star day here. And this is one that I'm thinking about looking at buying a long-term put and maybe even deep in the money put to make it, or deep out of the money put, so less than the price. Because let me show you one that did the same thing. And if my buddy Dr. Gupta is watching this, he'll attest that I was sitting years ago at a VectorVest meeting, and I went crazy buying and then shorting the daylights out of this stock. And this is Intercept, and it would have been in a January time frame. So let's see if I can find the right date. Here we go. So Intercept Pharma, and I want you to think about this in the same setting that I just talked about, that MDGL. So Intercept Pharma was a nothing biotech that had about 30 to 50 employees, and they came out, and I was sitting at this VectorVest meeting in Tampa. Dr. Gupta was sitting in the seat behind me, and they came out and they said, hey, we got a treatment for NASH. And I, a physician, goes, what WTF is NASH? Because I never heard of that term, and I did a quick research. I said, oh, it's hepatitis that's not hepatitis A, B, or C, and it's not an alcoholic. So we used to call that fatty liver, and that can cause cirrhosis. So everybody was pumped because here was the first good therapy for NASH, a disease that I didn't even know existed. Well, you can only imagine what the intraday charts look like. If you go from a prior day close, let's open up the data window. If you don't want to hear all this stuff, I'm not gonna go through any major new information the rest of my call. On the day before the news came out, this dinky company closed at $72. The next day, it opened at 231 and traded to 305. The next day, this was Thursday, this was Friday. The next day on Friday, it opened, so it closed the prior day at 275. It opened at 373, traded as high as 497. Now let's walk forward over time and see where the stock is trading today. Oh, by the way, they got their drug ultimately approved. So it went up on news. It stayed up a long time. I mean, I was so impressed. Then we had a little bit more news came in here. And I'm still watching. Oh, it's no longer $500. It's 144, which is still a big move from where it started. Okay. Oh, we're running again. Probably some news. Back in the 300s. 168, 120. Oh, we're starting to see double digits here. Are we going to get to double digits? I bet we will. So I'm just basically walking forward of why you got to be careful with Madrigal, because even though this guy's drug worked, it's in the same setting. It was the first to market. Um, where are we today? Let's just go look at where we are today. Well, we're not there, are we? I have to go down here. Oh, I think somebody told me there's another way of doing this. Oh, we are a $20 stock. So we went from 50 to over 500 and back to 20. I look at MDGL, and just the question is, how long is it going to take? Because I would bet you dollars to donuts this thing is going to do the same damn thing. There is no fundamental reason, in my opinion, of why this stock with pre-early data stays up here. But as we saw at the intercept, it took a while to get a round trip. Um, I talked about Moderna at 500. Moderna, and I love this company. I love what they're doing in cancer care, and I really hope and pray that their vaccine stuff, what they did with Merck, will pan out in other tumors because that's my specialty, cancer medicine. And if it does, the stock is cheap, 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 cheap. But right now, it's not cheap. It's expensive. And it was really expensive up here. And where is it at today? Probably going to go. If I was a betting person, it's probably still expensive today based upon its revenue and earnings. So that's where I wanted to cover. I think we're good. I just wanted to show you MDGL because that may be the mother of all shorts, but it's a risky short. Doesn't have a ton of volume, but I showed you some to the downside. And as we've talked about multiple times, one way to play to the short side, especially if you don't want to go short, is to play contra ETFs to the long side. Um, it was a bad week in the market. All right, so what happened? The dog, which goes up when the Dow goes down, was up. The SPXS or the SDS, which goes up when the S&P goes down, was up. The SQQQ, which goes up when the Qs go down, was up. The TZA, which goes up when the small caps go down, was up. And you could see all of the contras were up. That just tells you for a short period of time they're working. As I've said before, they are short-term trading instruments. They're not long-term investments. Again, sorry for the length. It's another hour report. There's a lot I wanted to talk about. Have an awesome week, guys, girls, ladies, gentlemen. Um, Please feel free to comment in the remarks section. Email me if you want to talk about something, and be careful out there.